Um, yeah, so I'm Ian. I work for a company called Consensys. Linea is one of the projects in Consensys. We also have other projects like MetaMask, which is a non-custodial wallet. We've been working also on a lot of other infrastructure for Ethereum, things like Infura, which is provides RPC access to the blockchain networks, which basically allows you to connect your website or your DApp to the blockchains. I've got my colleague here, Tobias, who's works on the diligence side, which is a security service that we provide to audit projects and smart contracts. And Consensys originally was set up basically to provide a set of infrastructure to allow developers to use Ethereum. Our founder and CEO was a co-founder of Ethereum alongside Vitalik. His name's Joe Lubin. And Linea is an open source public goods project. So anyone is welcome to use the Linea open source stack for if they want to roll out their own L2, or they can also contribute to the stack and help us sort of build out. I'm going to sort of try to do two things, and I'm hopefully not going to be too shilly. I'm going to try to explain a few sort of new things that are happening in DeFi, but also explain how Linea as a layer 2 can sort of help with those things as well. I'll be interested following on from Sebastian's question about who's used a non-custodial wallet. I'll be interested to see here in the audience who has used, with their non-custodial wallet, who has used DeFi in any form. Okay, so about 50%. So this is I'd consider quite an educated audience. So I'm going to try to sort of make it not too techy, but sort of bring in some of the latest developments that we've got. And by the way, big shout out to Safe. Just for information, we've used Safe multisigs for 7+ years to manage our own treasury with over hundreds of millions of dollars in there. So it's like those guys have been absolute legends in sort of keeping our ecosystem safe and being able to not have to pay custodians vast amounts of money. Yeah, great stuff. So the question is like, what do we need to build an on-chain economic system? This isn't exhaustive, but I thought I'd just sort of touch on a few sort of core principles of what an economy needs to be effective and valuable. And I think at the base of it, you need a secure network. And we started that journey off with Bitcoin. In the sort of real world, let's say, or TradFi, we've got things like Swift that sort of form that basis to allow for transfer across between banks. On top of that, you need a store of value. In sort of like traditional sort of environments, we're looking originally at things like gold, and then more recently we've had other forms of stores of value. And once again, the sort of in the sort of blockchain space, Bitcoin was our sort of OG store of value, and then more recently we've been using Ethereum as a store of value, and then there's obviously lots of other tokens out there that you can decide whether they've got stores of value or not. Beyond sort of, and that store of value is important because you need to have something that is going to hold value over time. If the underlying, even if you've got a good underlying network, but the assets then sort of leak out, then you end up with a valueless network. Beyond the store of value, then you need transferable money. Now that could be the store of value in itself, but in the real world, we've basically got fiat currencies, which we then move around and we can sort of easily send between bank accounts. And in sort of the on-chain world, we're talking about stable coins. And then we come on to some interesting points around baseline yield. And baseline yield exists in the real world through the sort of yield you get from your T-bills or your gilts. In our environment, Bitcoin doesn't have that, but Ethereum does. And if you stake your Ethereum, to secure the Ethereum network, then you get a yield back, roughly about sort of 3%. And that acts as a sort of baseline to secure the network, but also to attract value into the network. And I think it's really, really important for a healthy economy. Beyond getting the sort of core of the yield, you then need trading. And you need to allow people to be able to swap value. And typically we've got sort of markets like we've got the London Stock Exchange, NASDAQ, New York Stock Exchange, all of these places where trading can happen. And in our environment, we're talking about decentralized exchanges. We also have centralized exchanges, but I'm going to focus on the decentralized space with decentralized exchanges. And then we've got two other areas. This is not exhaustive, but we've got credit markets. And credit market would be, you can take out a loan from your bank. And on chain, we've got a number of borrowing lending markets. Maciek talked about Aave. I'll talk a little bit more about that. And then lastly, merchant adoption of those payment systems. And it was interesting, Sebastian talked a lot about that around, having Gnosis Pay being accepted in many different places. I think that's super, super important for this sort of foundations of the economy. So I'm going to dive into transferable money and what sort of, the latest that's happening here. The first point is that, stable coins have become a really core sort of part of like the financial infrastructure now. It's gone from being sort of people viewing it very skeptically. There's a lot of Tether FUD where people didn't believe that Tether had the backing. Now to like total supply of, almost getting to about $400 billion, and the number of transactions via stablecoins going beyond what Visa's doing. So this is a big deal now, and this is being taken really, really seriously by most banks. Are considering issuing their own stablecoins now. I know of at least 4 Hong Kong banks that are doing it. I was speaking to a couple of banks in Dubai when I was out there for Token 2049. This is, every single bank will probably issue its own private stablecoin. And I think the debate between central bank digital currencies and stablecoins, I think it's pretty much over. I don't think CBDCs are going to happen. And that very much is a world that I don't believe in, where you have this sort of state oversight over money, which means that, I could be told I can't transact with my CBDC because the government disagrees with me as to how I use my money. So I think that private stablecoins are very much the way that it's going. Innovation is also really happening in the stablecoin space, where we talk about not only do you have the fiat representation on chain, but you also have the ability to then earn yield back from those stablecoins. Athena is an example of that, where they're basically, if you use that stablecoin, you hold that stablecoin, you get the underlying yield back, and they do that through fees from derivative funding and as well as staking rewards. So there's a lot of innovation happening in the stablecoin space. The traditional stablecoins like Tether and Circle, they get to keep the yield. Tether is probably the most valuable company in the world now, but they keep all of that yield from the T-bills. These newer stablecoins are starting to share that out in different ways. So it's worthwhile looking at those. And then there's a lot of regulatory clarity that's coming or has come. MiCA in the EU, the Genus and Stable Acts in the US, and it's interesting just to see the SEC launching its Project Crypto more recently, whereby they're basically going to, as fast as possible, move all stock trading on chain as fast as they can. That's the sort of impression I get. So we're about to see some sort of major supercharged evolution of financial markets, from sort of TradFi, sort of 9 to 5 trading weekdays to sort of 24/7 on-chain trading of stocks. And that will be, and rather than the SEC attacking us, they're going to be right behind it. So I can't tell you how big the seismic shift is in the US. And that's why it's important for us in the UK to be up to speed on this, because I'm worried that UK markets are going to get left behind if they don't move super fast now. So talking about Linea a bit on the transferable money, We've got a whole load of US and non-US stablecoins on the network. Similar to Gnosis, we have like Monerium there with their Yuri and GPPE stablecoins. We've got a Brazilian real. We just launched a Canadian dollar, got a Canadian dollar launched, and we've launched the MetaMask card in Canada as well. So that's pretty exciting, and others. And I just see a vast number of new stablecoins, and especially localized stablecoins, arriving on the market and allowing us to do more sort of localized fiat payments on chain, as well as localized stablecoin payments on chain, as well as sort of start an emergence of FX markets on chain as well, which I think is going to be super interesting. And I think this unlocks a ton of stuff around things like trade finance, being able to do remittances in local currency rather than US dollars, being able to do all sorts of cool stuff. So we're pretty excited about that. In terms of like both the store of value and the baseline yield piece, I'm seeing evolution of staking as basically an institutional vehicle to getting access to yield. Our CEO, Joe Lubin, he's basically now chairman of a company called Sharplink Gaming, and their goal is to build the largest ETH treasury, similar to what MicroStrategy's done on the Bitcoin side. And all of that, or 90% of that ETH, is going to be put into direct validator node staking. So they'll be able to get that and do that at the least, the smallest fees in the market. So the idea is if you buy, for example, an SBET share, you will get the best return for your ETH on the market. And so I think we're seeing that also with a number of others. There's the Ethereum company's just been set up as well by some of our ex-colleagues at Consensys, who are also building an ETH treasury, and there's a few others like Bitmine and so on. So I think the sort of staking piece is going to be very important to treasuries, and that also will be very important for ETFs, as ETFs are allowed to get access to the yield and not just the underlying asset. So you can sort of stake directly onto a validator node. That means that you need at least 32 ETH. You can also stake through something called liquid staking, and there's services called like Lido. And that basically gives you back a sort of staked ETH token, which you can then use in DeFi. I think Lido are doing lots of interesting stuff here, whereby, for example, with V3, which is coming out in September, you're going to be able to not just stake blindly into all of the validators that back Lido. You're actually going to be able to specify, I want to use this specific node operator, and you'll be able to pick your custodian, and you'll also be able to choose when you mint it. So that gives institutions a lot more flexibility to pick providers that they trust, but still have a staked liquid token, which I think is super interesting. And then we move on to sort of what we call layer 2 native yield. And what's happening here is that newer layer 2s like ourselves, Linea and Katana, we're basically taking the ETH that is bridged across to our layer 2, we're then staking that, and then we're basically providing the rewards back to the community on the layer 2. So I think that this sort of idea of staking rewards coming into the layer 2s is going to like absolutely supercharge the adoption of layer 2s, both on the institutional front and within retail. So I think those are some really exciting stuff. And we just announced our native staking strategy, which will launch in October. That blog went out like 2 days ago, so it's brand new. But definitely check it out if you're interested in this concept of native yield. Sorry, on the layer 2. On the trading side, we're seeing a sort of evolution on the decentralized exchanges. We started off with things like Uniswap v2, and you've got basically with a decentralized exchange, you've got three parties, right? You've got the people who provide the liquidity, you've got the people who trade, and then you've got the people who hold the tokens. In Uniswap v2, basically, you had a synergy between the traders and the LPs, but there was no sort of synergy with the token holders. The token was basically a governance token. And then we saw the evolution to these V33 dexes, which, and examples of that are things like aerodrome and velodrome. Aerodrome being on Base, which is another layer 2 sponsored by Coinbase. And those started to bring the token into becoming more synergistic. So you would get the traders would generate fees, and those fees would go to token holders. Token holders would then provide incentives to the liquidity providers, and liquidity providers provide liquidity for the traders, and you get this sort of synergistic sort of triangle. But in that model, the tokens are locked, and you'd have to sort of lock them up for a period of time. And what we're now seeing is the emergence of these X33 DEXs, whereby the tokens are unlocked. And so you get this synergy between the three players, but the tokens themselves are unlocked. And so that's a super exciting innovation. And I've got some stuff to talk about afterwards on that. And then I think that the other trend I'm seeing is that traditional asset managers are starting to be more open to doing on-trade trading. And that's via the spot dexes that I've just been talking about, but also through perp dexes and also trading through the ETFs. So I think there's a ton of sort of TradFi asset managers that are now starting to shift. I'm seeing a lot of this happening in, let's say, Dubai, the US, Singapore. I'm hoping it's coming quickly to the UK as well. Just on the DEX side, we've got our X33 DEX just launched about a week and a half ago on Linea, called EtherX, and the actual token itself launches later on today, so that's super exciting. It wasn't planned, by the way. I didn't coincide this, but yeah, that will allow basically people who hold the REX token to basically vote to direct incentives to specific liquidity pools within the DEX, which is super exciting. And they will then also be rewarded through the fees that get generated, so by the traders. And yeah, before you sort of ape into any of these liquidity markets, please make sure you understand what impermanent loss means, and please make sure that you're educating yourself fully before you start to play around with liquidity pools, because typically an ETH to USDC liquidity pool, as a retail user, we will lose money over time. So you just have to be educated about what you're doing here, because it typically is sort of things that hedge fund managers are involved in, and market makers. On the credit market side, I think what's really interesting is like protocols like Aave, for example. You can now compare this to in the top 50 banks in the US in terms of TVL, 55 billion, I think back in May-June timeframe. And so this is becoming a serious business, and Aave itself is generating serious fees, which self-sustains the DAO and the operation of the labs group as well. So I think this is like a very interesting sort of, this is something that has endured over time and is really exciting. And then I see that there's an evolution now where on top of these markets, we're starting to see these curated vaults emerging through protocols like Morpho and Gauntlet. That allows for sort of being able to basically maximize how capital is used by automating sort of, let's say, the balancing of these pools or of these markets, and making things more automatic. Now, obviously, with a curated vault, you're adding another smart contract layer on top of the sort of capital market smart contract layer. But so there's extra risk, but there's also extra reward there. So asset managers will probably treat this more as a sort of higher risk exotic instrument. But they bring lots of transparency. There's lots of risk management capabilities that are being built around it. And there are vaults that are now institutional grade. So you can invest in a vault knowing that it's like OFAC compliant, that there's, the Lazarus group aren't doing anything with it, and so on. So I'm seeing institutional grade capabilities coming into the vault structure as well. And then in addition to that, obviously someone doesn't like vaults. in addition to that, I think what we're also seeing is the evolution of credit markets um, uh, with things like credit markets evolving to be able to make microloans for card payments or being able to do borrowing and lending across chains. So I could, for example, have all my assets sitting on Ethereum or Base, but actually my card works on Gnosis or on Linea, and I can borrow from those places and take out the loan on the chain where I'm actually making the payment. And I think that's really elegant in terms of like being able to not have to keep moving funds across chains, but actually leaving the funds where they are, but moving the money that I borrowed to the place where I need it. So I think there's a lot of exciting stuff. There's a lot of these sort of DeFi blocks sort of being built on top. And then on the merchant adoption side, similar to Gnosis, we launched a MetaMask debit card recently. It's basically sort of fully available across Europe and the Americas at the moment. We've done some interesting innovations with this card. It's a debit card rather than a credit card, and it allows you to keep custody of your assets right to the last moment. So you're literally leaving your stablecoins in your EOA wallet. And what we've even done is done something interesting, which has allowed someone to, for example, lend their US dollars into Aave and spend the AUSDC, which means that you just get yield right to the point where you've tapped your card at the merchant. And so we're starting to get this sort of evolution of, yield right to the point of spend, which I think is super cool. And similar to Gnosis, we've also got like a cashback incentive there as well. So yeah, and what we've done is we've been building out Linea as a layer 2. It's what we call a ZK rollup, which means that we take a large number of transactions. We use zero knowledge proof cryptography to basically wrap those transactions and post them onto Ethereum. So you inherit the security of Ethereum, but we have like a sort of more scalable and very, very cheap sort of low fee environment. And we see that environment being used for payments and many other sort of high transaction use cases. And it's going to be interesting to see also some of the institutional flows coming on to make use of the higher yields that are going to be offered on the layer 2s as well. So we're excited about that. Yeah, so hopefully that gives you a sort of basis for what I would call the sort of the foundations of an on-chain economy. And through Linea, we're trying to sort of support building that up. And if you're interested in getting involved, we will probably have one of the largest ecosystem funds in the industry come when we launch our own token. So please come and speak to me, and we'd love to hear what you guys are building and if we can help. Thanks so much.